In today's video, I am going to be breaking down the top dividend stocks for the month of March. Let's get down and let's check these out. We're going to go over some Canadian options and American options later on. And of course, we're going to be diving deep into what could happen in March, which could really affect the markets. So let's get down and let's check out these stocks. So this first stock is TD Bank for obvious reasons because they just made a massive purchase in the United States for a huge bank. That just made them the 6th largest bank in the United States and probably potentially the biggest bank in Canada when it comes to overall assets. From there, we want to really look at, of course, their dividend because, of course, this video is about their dividend and they are a 3.4% dividend, $3.56 per share per year. Now, I actually believe that dividend could be much larger very soon. The first quarter of 2023, of course, that's a year from now, the bank purchase in the States is going to close. And what does that mean for us? Well, that means that for TD, it's going to be a larger earnings per share. And that could also mean that in the future, their dividend could really explode to the upside because they're going to be making much bigger income from the United States. And when that happens, obviously, they're a bank, they want to pay out dividends to their shareholders. Also, the historical average when it comes to dividends on Canadian banks is around 4%, so that's actually quite a bit under the historical average, so they may just raise it very soon as well. Their average volume is 5.8 million shares, so it's easy to get in and out of it, and their PE ratio is 13. The historical average for banks is 11, so that right there is a bit high. But with the newly purchased bank in the United States, and of course, their massive earnings growth over the past year really does provide evidence that this actually could be okay, because if they're going to be making more income in the future, then that number will go down because more income means a lower PE ratio unless their stock price continues to skyrocket as it has been recently. Obviously, this also does really does be affected by what's happening over in Europe right now, but we're going to get into that a bit later. So before the virus, the stock was pretty much trading sideways. Obviously, there was a massive dip, and since then it's exploded to the upside. What we've seen is essentially evidence and proof that the banks can make money no matter what time it is, whether it's a recession or not a recession, because now they're charging bank fees. The banks are mostly not calling their branches anymore. They're now calling them stores because they have so many financial products. That's how they make money, whether it's a mortgage or even your retirement fund, they're making money. So because of that, they're going to be still making a ton of money. And we see that with the recent stock surge. Also, there's a kind of another reason why this is going up and nobody's really talking about it. When it comes to banks, when a government prints more money, where does that money go? It doesn't just stay in the pockets of the government. It could. Trudeau might take some of it. But other than that, that money generally goes to the consumers who then buy stuff because they're consumers, which then goes to big corporations. And whether you're a consumer, a small business, or a massive conglomerate, that money has to sit somewhere. They don't keep it in their beds, which means that it goes to banks. And that's another reason why every single bank has been going and exploding to the upside, because they're getting so much more cash on hand. And when that happens, that means that they can, when they receive money from you, they can loan it out 10 times over, which then means they make even more money. Now going into a time where interest rates are rising, they're going to make even more money. We can see that with the dividend rise. Obviously, they were not allowed to raise a dividend for a very long time, mainly because the government basically didn't let them. However, we've seen 4 beats for the past 4 quarters. We have March 3rd when they're coming out again with their 4th quarter. So that's going to be very interesting. Today, as of making this video, it's March 1st. So we're still waiting, of course, a couple of days. And when it comes to their revenue, we've seen that their revenue has gone up, but their earnings percentage-wise have gone up even larger. This is because they made massive cutbacks. And when I said this a year ago, these banks and companies who make cutbacks, they're not going to rehire as much as they cut back because they see that they can do the exact same, if not more, business with less amount of staff, which means that, of course, they make more profit. That's what we're seeing here. CIBC is one of my picks mainly because of their PE ratio. It's one of the lowest out of the big 6 banks, and they have a higher dividend too, and they have a very bright history on raising dividends usually twice a year, if not every single quarter. They also have some pretty large average volume too. So between those 3 factors, the biggest one being, of course, the PE ratio, it really does seem like a good investment right now. However, keep in mind what's happening over in Europe could really affect the entire world, and I would suggest right now also to potentially get maybe some actual physical gold or silver, because that's a lot easier to carry around if you're talking about a couple of $1,000s, and it's a good hedge on basically the world becoming, of course, Mad Max. And that probably won't happen, but I don't trust anybody. But again, just massive volume to the upside, and we continue to see that here. When we start looking at the actual MACD, we can see that they are starting to potentially converge, and there could be a little bit of a downside trend here, but they haven't touched yet. They're also nowhere close to the top, so this could still continue to trade to the upside, but the blue line is starting to level out, and that's always a sign that it could cross soon. We've also seen a massive dividend raise again. We've seen this with every single bank. However, their quarterly numbers, they did not do so well quarter 4. However, they have done extremely well in the 3 quarters prior. We've also seen that their revenue was massive, but what was even bigger was their earnings. Again, same reason probably as well. And we can see over here with their historic dividend that sometimes they will raise their dividend every single quarter, while other times it could be twice a year. Going on to American stocks, we're really going to be focusing on defense stocks this month. Now, I understand the argument that these have really exploded, pun was intended there, to the upside, and mainly because of what's happening over in Europe. And a lot of times when you start looking at defense stocks, you don't generally want to buy them leading into either a proxy war or a war of any kind, because usually what happens is the investors have already gone in, they'll take their large profits because the stocks will go massive, and they'll generally go down during a war. I personally don't think that this is anywhere close to a start of a war yet. I understand Russia has invaded Ukraine. I understand all of that. However, I really don't think that Russia is going to stop what they're doing. I think that they're going to continue to the rest of Europe, and I think that this could continue to lag on the markets, which may be a negative for banks when it comes to their stock price, but their business really hasn't changed at all because most of their business is not in Russia. However, companies like Bank of Nova Scotia, they have a very strong European presence, and they may have some downwards profits, or at least some negative things happen to their earnings from Europe because of what's happening. However, other banks like BMO and TD and CIBC, who have a lot of business in North America, don't really have as much of a problem as a bank like Bank of Nova Scotia, who has a lot of European assets. But Northrop Grumman, if this war does last more than a couple of weeks, you're going to see that, hey, every single small little provocation by Russia will push these stocks up higher. Right now it pays a 1.5% dividend, 800,000 shares traded on average every single day. And at the time of recording this video, at least pre-market wise when I was recording the screenshots, the stock was up 4.5%. This is why you don't want to buy when they're starting a war. You want to buy a couple of weeks after. So like literally in 3 or 4 days. That is when I would maybe think of continuing to buy this stock. And Tuesday, March 1st, at the time of recording this actual video, not the screenshot, the current stock sits at $449 a share, up $6.80 today. As we can see, anytime that there's a provocation, it spikes and then it kind of sinks back down. There's another provocation, kind of sits there and lingers and then pops back down. This is something that has happened many years, not just over 5 years. So this is a good stock to buy when it's usually low. Right now it's at a high, and depending on what happens, like this stock could continue to go higher because every time there's a new provocation, it's going to continue to spike higher. So for example, if Russia actually does figure out how to take Ukraine, which I personally don't think that they will, I think that they are very unorganized, and this is coming from somebody who comes from a military family, and from the stuff that I've talked to with my family, the Russians, from what we have seen, they are not organized and they will lose this war. However, if they do take Ukraine, they're not going to stop that. They're going to go over to Moldova, and they're probably then going to look at Lithuania or a few other countries. And if they keep on provocating and trying to take over more and more countries, this stock is not going to take a dip anytime soon. But if they can't get past Ukraine, which I don't think that they will, I think that they've got too many young kids who they've pulled up out of nowhere to try and fight a war that shouldn't be fighting, that I personally believe that they're not going to get past Ukraine and this stock could fall. However, if they do beat Ukraine, that's when we have to really take a serious look at stocks like this and say there's going to continue to be provocations. And if there is any kind of a massive war on, of course, Europe, then you're going to see this stock absolutely explode. And yes, the pun was intended. And yes, they do up their dividend quite frequently, which is no surprise. There's literally wars all around the world. And now with this whole idea that there's major players in the world who want to do harm, there's going to be more and more countries who are looking to invest in their military. And if they do that, of course, the dividend's going to continue to go higher. We've seen Germany as an example who has come out and said that they are looking at, for sure, spending more money. I think it was a couple of $1 billion towards their military, and they're going to be upping it to actual 2% GDP, which is what, of course, the United States government a few years ago was pushing them to do, and they never did. So because of that, I think there's going to be more and more countries who are going to say, oh my God, we are so underdeveloped when it comes to our military, we need to up the spending. And if that's the case, then the dividend's going to go higher. I personally do not invest in defense stocks. I never will. The reason is because I disagree with war. I hate war, and I think that it would be a better option if we just got the president of each country to get into a boxing ring and say, fight. Anyways, they've beat 4 quarters in a row, and I really think that this is going to be an underestimate for the future because I think there's just going to be so much money going into this stock, or at least this company. It's going to be crazy. Revenue was obviously down in 2021, but their earnings were up, which just tells me that they're probably cutting back staff because of the virus potentially. Who knows? But either way, if that's the case, then you can see the revenue go up, and definitely if they're having a higher percentage of earnings, then of course their earnings are going to go massively higher as well. Raytheon is another fantastic corporation. This one does a lot of the technology when it comes to military equipment, and this one does pay a 2% dividend, 5.8 million shares traded every single day. Again, this would be something more in line with what I would invest in, even though I don't invest in this company at all, and I don't have any plans to in the future. But the reason why I'm mentioning it is because I really want to kind of show some stocks that could actually benefit you. I might invest in this just because it's more on the defensive side, the technologies and things like that, but it's not a massive offensive strategy, even though they do have some offensive weapon technologies. Their stock was doing quite well before the virus, and of course there was massive spending towards, of course, more on the pharmaceutical side when it came to governments, so they were not spending probably as much, and that's why they kind of sat down longer than some other companies. But they have recovered, and I think it's a good idea to potentially look at starting to invest because they're back to where they were before the virus, so they haven't been one of those companies that have exploded massively higher since then. They do tend to raise their dividend occasionally as well. It seems like once a year that they do raise their dividend. They've also had 4 beats in a row, and something that I really like to see myself is revenue steadily growing, literally steadily. Like if we make a dot from here to there, it is literally a steady increase. The thing that does concern me is, of course, the earnings going lower, negative, and then lower here than it was here, and that was basically in line with here. So, of course, that probably just means that they're reinvesting in themselves, which is sometimes a good thing when you're talking about a defense stock. Lockheed Martin is another company. Of course, they do also pay a 2.75% dividend, 1.9 shares traded every single day, so it's easy to get in and out of it. PE ratio is higher than many other defense stocks as well, so something to kind of take a look at. They had that downturn, of course, when it came to 2019 and, of course, 2020, but we did not necessarily see it last very long. It did recover, and of course there was massive recovery from 2019. However, it really hasn't done much over the past couple of years since or while the virus was going. Now, you can take it as you want, but personally, this seems like a potentially good area to be buying in if this war does last longer than a couple of days longer. They also do tend to raise their dividend quite a bit too, so you're seeing a 10% dividend increase there, about 9%-ish there, another 8-ish% there, so you're still seeing quite nice dividend increases. We need to really look inwards and say we are a technologically advanced civilization. We may not have boots on the moon yet again, or boots on Mars, so we're not a multi-planetary species as of yet, but we are a global species, and we need to get along with each other. We literally, if I was to cut my arm open right now and have somebody from another race or religion next to me do the same thing, we have the exact same blood. So that means that we are the exact same species. We should not be hating each other, whether it comes to race, religion, or country that you currently were born or live in. Anyways, these are my thoughts. I'll see you guys in my next video.